Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. The webinar title today is KLCI, Opportunities in a Volatile Market. So welcome everybody to this session. My name is Shen Chu. I'm the moderator for this webinar. Now, the Malaysian's local index, namely FBM KLCI, has been performing well this year. And the US market has also reached all-time high. The Chinese market has also been spurred up by the local investment activities, by the more accommodative policies by the central bank. So the market seems to be recovering. And at the same time, we are also faced with a lot of uncertainties, namely there are US recessionary fears. Would there be a soft landing? So what are the opportunities in this volatile market? So today in this session, we're going to explore how will the US Fed policy affect the market directions moving forward. So before we begin, as usual, disclaimer, whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. Today, we are very honored to invite the Chief Investment Officer of RHB Asset Management Sdn Bhd, who is Mr. Muhammad Fauzi, to join us in this session. So as a CIO of equity, Mr. Fauzi's primary role is to set the strategic direction for the equity investment team in Malaysia, covering fund managers and analysts for both conventional and Islamic funds at RHBAM. So his other roles, among others, include integrating the Malaysian team with the rest of the RHBAM Group Asset Management investment team, as well as ensuring the investment team operates in a prudent and compliant manner. So he has a total of 30 years of working experience in managing life, private, and government-linked funds, as well as portfolios for retail and high net worth individuals. So today we are very honored to have you, Mr. Fauzi, to be joining us in this session. How are you, Mr. Fauzi?
Right. Thank you, Shen. I'm good. How are you?
I'm fine as well. So we can't wait to learn from you about the outlook. So I'll hand over the session to you.
All right. Thank you, Shen. Thank you, Bursa, for inviting. I think first of all, let me share my screen. Can everyone see my screen? Shen is.
Yes, you may go to your third slide, I guess, or the.
All right. Okay.
Yes, third slide. Yes, that's right.
Right. Good evening, everyone. Assalamualaikum to everyone also. I think like what Shen mentioned just now, the market has been good actually. Year to date, Malaysia has been one of the performing market year to date. But I think can PCI actually maintain its uptrends? I will try to answer the question. I think in this presentation, hopefully, I think everyone can get some insight on the equity market overall, globally as well. I think in particular for Malaysia, since I think we are investing in Malaysia in particular. So I think let me start with the agenda. Today I think we are going to talk about the outlook. I will briefly mention like what Shen mentioned just now, the US market, US economy, and also on the thing nearer to our side is China, and I will conclude the equity market outlook, focusing on Malaysia. So I think the last before I start, actually this is one of the investment guru quotes actually. The stock market can be inefficient in the short term due to sentiments, but over the longer term, it tends to follow the fundamentals. So I think this is very important quotes actually for those who wants to invest in equities. You might experience with a lot of noises actually in the short term. But I think most important thing is to look or to focus on the fundamental of the country or fundamental of the stocks that we are investing in. So hopefully for the longer term, actually, we can get some return out of our investment. Investment is not like a short-term one. Yes, I think maybe sometime we can get a quick return, but that may be luck, I guess. But I think if we focus on the fundamental, we studied or we do the analysis actually thoroughly on the stocks that we invest in. Actually, we get, I think, returns, good returns in the longer term. I think like what Shan mentioned just now, there are noises actually in the market at the moment. The first thing I think that we should take into what do you call it consideration is whether U.S. economy is going into soft or hard landing. I think this is the thing that keeps the market actually volatile. But in this, I think last month, this was in September, there are two market friendly announcements that was positive or that were positive actually for the market. The first one is the Fed, which announcement they have cut interest rate by 50 basis point. They have kept the interest rate high at around 5.25 to 5.5 actually for quite a long period of time. And then I think this is in September, we saw the first time, or we heard the first time that Fed has cut its interest rate by 50 basis point. That is the first market, so-called market friendly actually news that affect or that has charted the directions of the market for the last 2 to 3 weeks. The other one, I think also market friendly, is the announcement by the Central Bank of China actually. They announced a series of stimulus measures to support the economy. So I think that is also good for the economy, global economy as a whole, and also it will help also Asia in particular, and also I think Malaysia will benefit also once Chinese economy starts to recover, because I think Malaysia is because we trade a lot actually with China. Our exports to China is quite big, close to about 18% export to China. So if China starts to recover, I think that will also help our export, and I think in turn will also help our economy going forward. So I think let me bring you to the first news actually, or the first point, whether US economy going into soft or hard landing. So I think looking at this chart actually, what we can see, the jobless claim numbers actually in the US decline as the layoff remains low. So this I think has helped to allay some fears that the labor market was deteriorating in the US, because labor market is important for the US economy, since I think about 60 to 70% of US GDP is supported by domestic consumptions. So if the labor market is not doing well, I think that will in turn actually have an impact actually on US economy going forward, and also will have an impact on global economy going forward. So I think from the chart actually, what you can see, the jobless claim actually or benefits decline, and then we can see actually the layoff remains low, so helping to, like what I mentioned earlier, fears that the labor market was deteriorating in the US. So this may then we hope for a larger cut in September. This is what we think initially for the US for what maybe Fed wants to do. I think Fed comes with 50 basis point cuts last 2 weeks. But I think it also in our opinion risks the hope that the economy in US might not go into a recession. The number of people claim the unemployment benefits actually in the US dropped by 5,000 from the previous week to around 227,000 for the period ending 31st August 2024. I think that has helped the market a bit, because the market was a bit worried whether these numbers actually will increase, and then that will shows the weakness in the US labor market. What we also notice actually, the wage growth in the US has improved slightly in August to 3.8% for the preceding 12 months, compared to about 3.6% for the 12 months ending in July. So from the chart actually, the wage growth I think is down. What you can see is down considerably from the level reached in recent years. But this data also, like what I mentioned just now, the wage growth, although it has come down, but I think it remains healthy for now. So that also may suggest that the US economy might not go into recession, which is good actually for to sustain the domestic US domestic consumptions. And also I think if US could avoid recessions, then it will also help the global economy to recover as well. And then also I think it will also help Asia economy and also Malaysia in particular to sustain the recovery in the economy. The thing that I've been mentioning actually from the beginning is US consumer. From the chart actually, we can see US, they are still spending strongly, although I think we know that the inflation numbers are quite high last 2 years, and then I think has started to come down, and then I think that but I think in terms of spending actually, the US consumers still spending quite robustly. What we can see, I think from the chart, the US retail sales rose more than expected in July, which could help also allay financial market fears of sharp economic slowdown. Retail sales in the US increased by about 1% in July, which was above the market expectations of 0.3%. So the strong sales, I think the strong retail sales suggested that the consumer is really strong actually to justify the fears of recession. This is, I think, the most important thing that the Fed was looking at or is still looking at in order to make or in order to whether to cut interest rate going forward or whether they want to cut interest rate more. The US inflation actually from the chart, actually what you can see, US inflation year on year and US inflation month on month, it has been going down actually, and also the US PCE, which the Fed the most important or the most important indicators actually for the Fed to follow is on the right hand side of the chart, which is the US PCE. We can see actually the US PCE year on year and also month on month has been also going down. So I think based on this, the Fed has announced actually early in September that the time has come for them to cut the interest rate. And then also I think in somewhere in the middle of September, actually they have cut the interest rate by 50 basis point. As what we see, I think actually the inflation has come down, and then what we saw also, I think earlier in my presentation, actually the labor market also slowing down, but not but still actually quite strong, although it has come down in terms of labor market, but still doesn't I think doesn't indicates that the economy in the US is going into recession. So I think the Fed now, since the inflation numbers has come down and then it's under Fed or under their control actually. So now they are focusing more on the labor in the US, and also they are focusing on the US growth as well. So I think that is why we think that why Fed actually cut the interest rate by 50 basis point, because I think in their mind they have done enough actually to control the inflations. And then also I think Fed reiterated their objective to restore price stability while maintaining a strong labor market. So while inflation remains above the Fed goal, which is about 2%, but it has come down actually from the peak of about 7.1% in 2022. The central bank preferred inflation gauge, which is the PCE numbers that I mentioned just now, has also come down actually quite drastically. So now I think the PCE numbers is actually moving towards the Fed target of around 2%. So I think in terms of manufacturing, also what we can see, the US manufacturing activities has improved slightly. On the left hand side is the US ISM manufacturing PMI, and on the right hand side is the US ISM services PMI. I think both you can see actually has rebounded or has improved slightly. The ISM manufacturing purchasing manager rose to about 47.2 last month from 46.8 in July, and also, but I think this was below market expectation of about 47.5, and then the continued weakness I think has raised the likelihood that the Fed would lower its benchmark, which the Fed has already done it the last 2 weeks actually. So I think the cut in the interest rate actually may help to spur again the demand in the US, and also we could see actually a potential rebound in US manufacturing activities going forward. So I think overall, what we want to say here, or in our opinion, we think that the U.S. economy might slow down, but we think that the U.S. economy might avoid recessions going forward, which is, I think, is a positive points actually for the whole global economy, because we also don't want to see U.S. economy going into recessions. The slowdown is imminent because I think for the past few years, U.S. economy has been quite strong, but I think because of the prolonged high interest rate environment in the U.S., that has more or less, I think, impacted U.S. economy a bit. But I think whatever U.S. government or Fed has done actually last month by cutting interest rate about 50 basis point, I think that will help manufacturing activities to improve going forward. And also, I think the consumptions also is likely to improve also as a result of the rate cuts in the U.S. And I think maybe they can focus now more on growth, as I think inflation is under control at the moment. Then the other thing also I think Fed also mentioned that they are going to cut further interest rate in the US. Most probably by end of this year, we could see another 50 basis point cuts by the Central Bank of US. And also going forward next year, also I think there will be more cuts that the market is expecting. And also Fed also has also indicated that they will cut more next year also, and then to continue until 2026. So I think that will help US economy from going into recession. I think we having talked a bit about the US economy. Then I think we go into China. I think China, although they have done quite a lot also for the past 1 year in order to revive their economy, but it seems that the numbers actually have not been coming. China economy is still weak, especially their property market, which is the backbone of the economy. I think that has that has shaken the confidence actually, whether Chinese government has done enough actually to stabilize the economy and to restore the economy. And then I think it's reflected in the equity market. Chinese equity market was among the most underperforming market globally before the central bank actually announced their stimulus package last week, which has helped the stock market actually to recover quite strongly. One of the Chinese index actually has recovered around 14% within a period of 1 week after the government announced the stimulus package. But I think before that, I think what we can see, the China retail sales actually, it has grown a bit before the stimulus package announcement last week. If you can see from the chart there, the retail sales grew about 2.7% in July, slightly beating forecast of about 2.6%. I think this is one of the main concern for the China or for the Chinese government actually, because the sales or the retail sales doesn't grow as strong as what they want it to be actually. So it's just maintaining around 2% to 3%. So that there is a fear that China may not achieve its GDP growth projection of about 5% this year. I think most of the economists are expecting below 5% GDP growth for China this year before the announcement of the stimulus package by the central bank last week. So, but having said that, what we think is, although China economy was not that strong, but I think we can still see some growth in China actually. They can still, I think in terms of economy, maybe they can still achieve above 4%, but it will be below 5%. If they will not go into recession. But I think with the stimulus package, actually, the hope is they are able to achieve the 5% GDP growth target actually, and also start to then China economy will start to recover from now actually. Which also I think good news for Asia and also good news for Malaysia in particular. So I think most important thing is to see whether retail sales in August and in September to pick up enough actually to make the consumption, because consumption is a major contributor to the growth in China. Like what I mentioned just now, they have done a few measures actually since early this year to stimulate the economy, but I think the impact is not great. The economy is still weak actually in China. So hopefully with the stimulus package that they announced last week, it would help to stimulate the economy in China actually, because I think consumptions is one of the important thing actually to spur the domestic activities in China. What we can also see the manufacturing numbers in China. This is China Caixin manufacturing PMI. Both actually the services, although services you can see is dipped slightly, but the manufacturing activities has recovered, but not as strong as what is expected. And then I think what we can see, the manufacturing numbers rose to about 50.4 in August from 49.8, which was above the market consensus of about 50 as the new orders return to growth. And then I think the other things that we have to note is like what I mentioned here, the government actually is targeting fresh stimulus at household level in order to what do you call it, to stimulate the economy in China. I think this is the most important thing that has affected the economy in China. I think we know that the property market actually has not been doing well for the past few years. Besides measures are taken by the Chinese government to improve the property market, but what we can see especially from the chart, the residential property sales, the new home prices actually keep on going down actually. Although I think they have taken some measures to revive the property market in China. So I think because of the slowdown in the property market there, that is why the central bank of China actually announced major stimulus package last week in order to revive the property market, because property market has been a key driver actually to their economy since the country began opening its market in the 1980s. Major contributor to the economy. So I think with now I think we can see actually they already started to introduce bold measures actually to revive the property market in China. So hopefully with that, I guess it will help also China or Chinese consumptions to grow, and also will also helps China economy to recover. I think what they have done last week was there are I think there are a few things that the Central Bank of China has done actually. The first, and I think the first thing that what they have done is actually to announce a sweep a sweep of measures to show up the economy and also to revive the property market. What the central bank has done, they have announced actually uh, the 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 cut in the reserve requirement ratio. Uh, so I think the amount of cash that the bank must keep in the reserve will be lowered by 0.5 percentage point. So that will release at least about estimated about 1 trillion yuan, which is about 142 billion US dollar into the economy. And also, I think what we also heard, they may also cut further the RRR further this year by another 25 basis point to about 50 basis point. So apart from that, what they have done is they have also lowered the 7-day reverse repurchases rates to 1.5% from 1.7%. And I think apart from that, they also announced about 113 billion stabilization fund, something similar to what we have done before during GFC. What I think the government has done at that time to establish a value cap to support the stock market in Malaysia at that time. I think so. The PBOC also announced about 113 billion stabilization funds to support the equity market in China. And also, I think apart from that, in order to revive the property market in China, I think they have also lowered down the down payment actually for second homes. The minimum down payment ratio for second home has been reduced to 15% from the previous rate of about 25%. So this, I think, is making it easier for people actually to upgrade to larger homes. And also, I think the other measures is the homeowners now can renegotiate their mortgage terms with their current lenders. And also the last, I think the last one that they announced was the PBOC increase its lending program for the state-owned enterprises to buy unsold properties, and also the funding for 100% of the principal of bank loans for such purchases up to about 60%. So I think that will help to stimulate property sectors back in China. So I think these are the two what I mentioned just now, the Fed cuts rate and the stimulus package announced by the Chinese central bank. These are the two so-called market friendly news, I think, in September, which helps to I think which also help the sentiment of the equity market globally. Besides that, I think the China export is still strong. I think this is the only factors or the only thing because I think we have seen that most of the indicators in China is either weak or is going down. But I think only export actually helps Chinese economy this year. It has I think the export rose by about 8.7%, which beat the forecast. So but I think it's not enough for export alone. Actually, it's not enough actually to sustain economic activities in China. So that is why I think the PBOC has announced the stimulus package last week. So that is US as well as China. A brief descriptions what happening in US and also in China, which I think has helped the sentiment or improve the sentiment for the past 2 weeks, actually, especially last week with the announcement of the stimulus package in China. So we go back to Malaysia. I think like what Shen mentioned earlier, our CI has been doing quite strongly actually. Year to date, we are one of the most performing market actually in the region before China announced the stimulus package. But I think after China announced the stimulus package, we can see most of the Chinese indices actually gone up quite a lot. As at last Monday or as at yesterday actually, today the market is closed. As at yesterday, the rebound in the equity market in China was quite strong. So I think they are year to date as at 30th September, they are among the best performing market in the region, surpassing Japan's stock market. I think also higher than Malaysia index actually. Although I think for most of the year actually until August, until September, we are among the best performing market in the region. This is what you can see here is actually the return of the KLCI as at 15 September. We were up by almost 13.6%. I think this is the first time that we saw quite a strong return for the KLCI. I think we hardly see this return actually for the past few years. Because a lot of I think uncertainties around. I remember last year when I presented, the market was quite low, so that's why I think we were quite positive on the market on the 12-month basis. So I think this year we can see the market started to rebound. and then give a positive return. So there are a few factors actually which contributed to the strong performance of the CI year to date. As at 15 September is about 13.6%. First and foremost, is our improving economic outlook. Then I think like what I mentioned just now, valuation is still attractive. Last year was very cheap, and then this year, although the market has gone up actually, but we still think that the valuation is still attractive for Malaysia. And besides improving economic outlook and attractive valuation, we saw, I think, strong market liquidity this year from both local as well as foreign. And apart from that, since foreigners actually has been selling our market for the past few years, so the holdings actually is quite low. So any good news actually, they will start to come back to Malaysia. And also I think with undervalued currency, it will also helps liquidity, or it will also help the foreign investors to buy Malaysia stocks actually, which is cheap at the moment. Our economy was strong actually, and is improving. I think we saw the second quarter GDP growth, which is at about 5.9% in the second quarter. That was higher than the first quarter of this year at 4.2%, and also slightly higher than the 5.8%, the estimate 5.8% reported earlier by the Department of Statistics Malaysia. So the GDP is actually supported by robust growth in private consumption and also private investment. So I think that has helped the economy in the second quarter. Besides other sectors also, the domestic demand was also firmer, and the net external demand was a plus to the economy, as I think export also rebounded quite nicely in 2024 compared to 2023. So I think a few combinations actually that has supported the economy in the second quarter of this year. Going forward, we think that the economy should be supported because what we think is we can see from a few indicators that the economy might improve further in this second half of this year. So I think that will be a good factors actually for the recovery in the corporate earnings going forward, because most important thing for the market to sustain is upward trends actually. There are the index or the uptrend must be supported by strong economy, and also must be supported by strong corporate earnings growth. So we have seen the economy started to grow actually quite what do you call it, strongly in the second quarter of this year, but we have yet to see actually it reflected or it been captured actually by the corporate earnings. So what we think with the improving economic outlook, it should benefit actually the corporates going forward. The corporate should deliver stronger earnings going forward as our economy improve further in the second half of this year. what we can see actually in terms of a few indicators that I want to show. The first one is the industrial productions. What we saw, the industrial production growth strengthened to about 5.3% year on year in July compared to 5%. This compared to what 5% which match the consensus expectation. The growth was underpinned by stronger manufacturing as well as electricity productions, and also manufacturing sector was lifted by both actually the strong strong manufacturing activities also. But I think what I want to highlight also, we think that the manufacturing activities will continue to grow stronger, because I think like what we heard from the PM also, I think he has announced that the approved investment this year has rose by about 18% year on year in the first half of 2024 to around 160 billion. So I think this is the so-called investment upcycle for Malaysia. And then I think the investment upcycle will support actually the economic growth going forward. And also I think the macro investment upcycle also historically what we can see has a positive impact on the economy and also has a positive impact on the stock market overall. And then the export will also, what we saw actually, export has helped us quite a lot in the first half of this year into the, I think year to date, you can see as of July, the export jumped about 12.3%, which was the fastest growth in nearly 2 years. But I think we still need to bear in mind if any downside risk actually stemming from the geopolitical conflicts and also rising concern over the sluggish growth in China and weaker growth in the US. But hopefully with whatever I mentioned just now, US cutting interest rate, PBOC announced stimulus package, hopefully that will also sustain our exports growth going forward. The employment market also remains healthy actually for Malaysia on the left hand side. Then also we can see the manufacturing wages also has rebounded. So I think this is good actually. If this remains, then I think it will help our economy going forward in terms of domestic consumptions. And also I think rising tourism activities also will also help the expansion actually in export and also the implementation of job related initiatives. So I think overall in terms of manufacturing activities in Malaysia, coupled with the exports numbers and then good employment market, so that will help to support domestic consumptions going forward for Malaysia. Besides, I think the salary adjustment for these civil servants also will help the economy going forward in terms of sustaining actually domestic consumptions. Then besides that, the inflations remain low for Malaysia. So I think that is good that for Malaysia, because Bank Negara also may not need to increase the rates going forward. So that was a bit of on the outlook, which is improving in our opinion. In terms of valuations. I think when people talk about equity market, when people talk about the stock market, there are two things that influence or that can determine the directions of the stock market. The first one, like what I mentioned, is the corporate earnings actually. If the economy grows, it should be captured actually by the corporates. And the other one is price to earnings ratio. So these are the two factors that would determine the directions of the stock market. So what I want to highlight here is there are still room for the market to go higher. What I want to highlight is, if you may see from the charts there, from 2015 until 2018, our stock market or our index actually was traded around mean valuation, which is the bold red line in the middle there, up to 2 standard deviations, which is the blue line above the red line. At that time, actually, our economy was okay, not that strong, but our economy was growing. Corporate earnings deliver positive return actually to the shareholders or to the investors, and also the liquidity was there. We saw foreign investors actually bought Malaysian stocks from 2015 to 2018. And then also, I think another thing is politically we are stable also during that time. So at that time, the index was traded at around 16 times PE to about 18 times PE. And then I think last year when I presented was the at this low, I guess the market was at one standard close to -2 standard deviations below the mean, which we think that is cheap actually. Like what I mentioned, the earnings growth, corporate earnings growth has rebounded this year, and it was, I think it is positive for this year compared with negative last few years actually. So that is positive for the market. I think the market, because of the improving outlook, improving economic outlook, stable politics, and then we have positive corporate earnings. I think that has pushed the market to positive 2 standard deviations above the mean, which is at this level. But since then, I think the market has corrected, came back down to around 1 standard deviations above the mean, which I think is healthy correction, because the market has already gone up quite a lot. So what we think is at this level, the market is trading at around 14.4 times PE, which is below the range of 16 times and 18 times from 2015 and 2018. So, but I think like what I mentioned, there are two factors that will sustain the uptrend in the index. The first one is the PE expansion. The second one is the earnings. So we need to see stronger earnings growth actually going forward in order for the KLCI to sustain or to continue with its uptrend. But having said that, the earnings growth was upgraded, although not that strong. Earnings growth was upgraded slightly after the conclusions of the second quarter 2024 earnings season. But I think we believe that the corporate earnings are likely to be upgraded in the second half of this year. As what we saw just now, I think the macro indicators pointing towards better economy in the second half of this year. There are still room. In our opinion, there are still room for the index to go up higher. This is another indicators that we follow, the KLCI market cap over GDP. If you can see from the chart there, this is the current KLCI market cap against GDP. This was in 2017. So if we think that the economy likely to go or to improve going forward, the market cap to GDP ratio is not here actually. It should be lower than this level. So we have seen 2017 around 5.6, 5.7 times is the highest. So if going forward, if the GDP going forward is higher, is stronger than now, actually, the ratio should be lower than what we saw actually on this chart. So that's what I think we believe that there is room for the index to go higher from current level. So I think besides the economy, besides the attractive valuation, I think the market is also supported by strong market liquidity. I think for the first time also we saw that foreigners are the biggest buyers for Malaysia market this year, around 3.43 billion actually. I think last month, September, they are still net buyer of the market. But I think it also supported by our local institutions. So there are two, I think the market is not only supported by the foreigners actually, but also supported by the local institutions. So this is the first time actually where we saw both foreign institution and local institution are the big buyers of the market. Besides that, I think like what I mentioned earlier, foreign ownership still low for Malaysia. As at August was only 19.8%. You can see, I think in 2014, the foreign ownership was about 24%, 24.3%. Then it came down quite substantially and has been hovering around 19 to 20% for the past few years. So with the better outlook going forward for the economy, attractive valuations, better corporate earnings growth, and also stable politics, we think that we can see more foreign inflows actually come into Malaysia. And then also I think because of the cuts in the interest rate, US interest rate, that will strengthen actually US ringgit against US dollar. So historically, the market will benefit when US dollar is weakening. And then also I think the last point is the undervalued currency. Not only Malaysia, but Asian currency was undervalued. This was about 1 month ago, where you can see China, South Korea, Thailand, Malaysia, Indonesia, Brazil, Chile, and South Africa. I think these currencies are undervalued. We have seen Malaysia ringgit actually strengthening to around 4 point. This today back to about 4.18, 4.19 level. From yesterday was quite strong, as strong as about 4.10. But I think overall, what I want to mention, the directions is actually favorable to ringgit as US cuts interest rate, and then and then we also can see that like what I mentioned, the economy is also improving. So I think it's a combination of economy, better economy going forward, and also US cuts the interest rate. The charts on the right hand side there shows that the relationship between the ringgit and USD, and also the CI. So as USD weakening, we can see the CI rebounded also. So we think that the as US will cut more, actually going forward. It will benefits ringgit, or it will going forward as well. So I think as a conclusion, there are a few factors that we think that will be positive for our stock market. The first one is what I mentioned just now, is the improving domestic economy. Number two is stable politics, and three, expectation of better corporate earnings going forward, and also I think attractive valuations for the CI. And lastly is the low foreign holdings in Malaysia year to date. Although they have been buyer or net buying Malaysia market, we still think that there are still room for the foreign investors to come back to Malaysia market actually. But I think there are also some concern actually that we need to 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 consider actually. Although what I mentioned just now, we don't expect recessions in the US. We do expect a soft landing in the US, but the uneven US job market also sometimes raise expectation that US is heading into uncertain economic outlook. So I think that may heighten fears of hard landing. The other one is if say that deep US equity market correction, if hard landing concern escalates for the US. And also I think the escalation of geopolitical tensions in the Middle East, as well as the growth in China actually, whether China can avoid a GDP growth below 5%. But I think with the stimulus package, there are some positive news there. So hopefully Chinese economy can achieve the 5% GDP growth as what they projected particularly since the beginning of the year. So I think that's all from me. I hope it can give some insight to the market. Hope that is clear actually to everyone. So I think thank you. Back to you, Shan.
Thanks, Mr. Fauzi, for your excellent presentation on the market outlook. So if any question to ask our speaker today, please write them at the Q&A box. Due to the limited amount of time, I think we shall limit the Q&A to 3 questions. All right. So the first question is by Sean Liu. So Mr. Fauzi, what are your views on the recent rally in China and Hong Kong market? Are they sustainable? Will it recover to the pre-pandemic levels?
Okay. In my view, because I think we have seen Chinese market, they have not been performing actually since they open since COVID time, and then when they open back their economy, it was short-lived also. But and then also the China's government actually they just reopened their economy after they closed down their economy with no, what do you call it, strong actually stimulus package actually, because I think they have not done that. So the market found it quite disappointing actually, because they have not done anything to stimulate their economy, unlike US Fed actually. US central bank, they cut interest rate, and then they inject the economy with the liquidity. But Chinese government has not done that the past 2 years actually, after they reopen their economy. So I think that has with that actually it doesn't help their economy. We saw that their economy is still quite weak in terms of manufacturing activities, in terms of retail sales. I think like what you can see from the chart, the retail sales was weak, actually below expectations, because I think the property market was bad. The Chinese government tried to curb the excessive so-called speculation. So that has affected the sentiment. And also, like what I mentioned just now, the interest rate was a bit high, and then if people wants to buy new houses, also I think that they need to pay higher deposits, and then because of the bank also they quite selective actually. So that has affected the demand for the property for the property in China. So we can see the property prices actually, and also sales has come down quite significantly. That I think with that one, and then the other thing is we saw I think a lot of things happening in property market which also discourage actually investors, especially foreign investors, to come or to go back to China to invest. So that also has affected the 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 property market as well as the equity market in China. I think, but with then that is one part on the macro. On the other hand, actually, as the stock prices in China goes down, I think like what I mentioned, and then the point is valuation. I think also becoming more attractive for China. So as at last month, it's quite low actually in terms of valuations in China, like what we saw for Malaysia last year. You need a spark actually for the China economy, the Chinese stock market to recover. So I think happened that last week when the PBOC announced the stimulus package actually. So that has excited the market. The market has rebounded, but I think to me we still need to see whether whatever measures actually that was announced will be translated into the numbers or into economic numbers. I think the whatever rebound is because of the Chinese market has gone down quite a lot, I think, for the past few years. So this is the first phase actually where market react to the positive news. But I think at the end of the day, we still need to look at the back to fundamental, like what I mentioned just now, back to fundamental, whether whatever the Chinese government, whatever they have done actually, will be translated into good economic number or good economic data. So I think for now, maybe there's some room for the market, but I think to me it's quite risky because I think it's just mere the liquidity push. We still need to see the fundamental of whatever they have announced to be translated into better economic numbers actually. Hope that explain, Chen.
Yep, thanks for your answer, Mr. Fauzi. Thanks for sharing your view. So the next question is asked by Steve Fu. Now the FBM KLCI index have been trending up. This is only contributed by a few sectors, namely financials, utilities, and some of the big caps names. Most top 100 mid caps and small caps have been bearish since July and dropped almost 20%. So going forward in the fourth quarter, how high is the possibility that these laggards sectors, mid caps and the small caps, can catch up? So that's his question.
All right, thanks. We have actually, if we look at the market, the overall market actually, we have the CI index, we have the 70 index, which is the mid cap index, and then we have the small cap index, and also the fledgling index, which is the smallest one. there are four indices actually that we can monitor. In the first half of this year, or for the first 7 or 8 months of this year, the mid cap and the smaller cap actually perform relatively better than the CI. Although CI just now up as at 15 September 13.5%, but the smaller cap and the mid cap index actually were higher in terms of return compared to the CI. First and foremost, because in the mid cap space actually, and then the smaller cap space, there are few sectors, I think like what you pointed rightly just now, there are few sectors dominating this small and mid cap, which are the constructions, the property, the technology. Actually, these are among the three sectors that dominated the mid cap space and the smaller cap space. Okay, so for the government, actually they have announced a lot of projects, construction projects and data centers actually, that what we know, that helps the constructions and the property. Most of the constructions and the property stocks or names are not in the CI. Okay, and then in the other sectors that contributed a lot to the small and mid cap stocks, mid caps index, was the technology sectors. Technology sectors actually, the semiconductors industry has rebounded since last November globally. But historically, companies in Malaysia and companies in Singapore will also benefit. But company in Singapore actually, we can see the revive or what I want to say, the semiconductor industry has rebounded. So the earnings actually, they will benefit. Singapore company will tend to benefit faster than Malaysian company. Normally, Singapore companies is about 3 to 6 months earlier. So the last year, November, the semiconductor industry start to rebound. So we could see semiconductor companies in Singapore will benefit, or we can see the profits actually, or the earnings actually. We can see the earnings for Singapore companies in the second quarter of this year. But for Malaysian companies, it will be slightly later than the 3 to 6 months, maybe about 9 months. So we can see only the earnings actually in the third quarter of this year. But I think because of the ringgit appreciation in the ringgit, which was quite strong to us, that might have an impact also on the semiconductor companies in Malaysia. So we might see the delay in their earnings, positive earnings. So maybe we don't see in the third quarter of this year, or maybe we see only the earnings will come back maybe next year. So I think in terms of that in the stronger ringgit, and also I think the results actually, the prices has already come down quite, like what you mentioned. So the prices actually has come down quite a lot the past 1.5 months. But on the other side, actually, the fundamentals remains the same, which the demand has started to rebound last year. So it may benefit, or it would benefit the semiconductor or the technology companies in Malaysia maybe next year onwards. But the stronger ringgit recently actually has affected the earnings for technology sector. So I think in terms of earnings, technology earnings company actually has come or will come down, because in anticipation of lower earnings, so that's why the market has already reacted to the stronger ringgit actually, because ringgit from the beginning of this year until yesterday, ringgit has gone up about 13 to 14%. So that will impact negatively on semiconductor or technology companies in Malaysia. But I think going forward, if the demand continue to be strong, and then ringgit, say that if ringgit stays at this level, then we can see the earnings starts to recover again for the technology sectors. So that is my answer to that.
Yeah, thanks, Mr. Fauzi, for sharing your view.
Thank you.
So the next question, and perhaps the last questions, because we have overrun the session, is about the US election. Now we know that the US presidential election is happening 5th of November next month. So what is your view about the outcome, like how it will impact the Malaysian market? If Donald Trump was elected, how will it impact the market? And if Kamala Harris was elected, how will it impact the Malaysian market?
Right. Okay, I think this is another uncertainties that will have an implication or will affect our market, maybe from now until the conclusions of the presidential election. They know at the moment nobody knows actually who will win, but the recent one is Kamala Harris actually have some advantage over Donald Trump. So if say that in our opinion, if Democrat wins the election or Kamala Harris wins the election, it will remain, I think, status quo. Whatever we are seeing at the moment, it will remain actually, and then the conflict, or not the conflict, I think they are still attacking China over whatever policies actually, and then that will help Malaysia actually in terms of manufacturing activities, because I think we heard China plus one already. A lot of companies are not only Chinese company, but I think other companies, multinational companies, they setting up their base or their manufacturing plant in Malaysia, which helps the economy, I think, going forward. And then also I think in terms of the currency also, I think, because they normally don't interfere with the interest rate direction, because that is under central bank. So as ringgit strengthen, actually that will also, like what I mentioned, benefit Malaysia equity. And then in terms of, if say that if Trump wins, I think that there are few possibilities, but I think it will, I think the first thing that he will do, I think like last time, he will cut the interest rate, he will cut the corporate tax rate in US. That will help actually US corporates to show or to grow in terms of earnings. So I think that might and then also I think they, like Trump last time also, he will do a lot of stimulus package, inject liquidity into the economy. So that will also in terms of, I think, weaken the US currency as well. But on the other hand, is actually I think we are all of the opinion that we could see actually inflation start to go up again in US. So if that happened, then I think whatever projections on the interest rate cut might not happen, because of if inflation starts to go up again, and then that will also affect the money flows, which is in favor of Asian currencies. Now the money flows might go back to to US. So that is my answer if to that question. Hopefully that answered the question also.
Yep. Thanks, Mr. Fauzi. So that's all the time we have for Q&A with Mr. Fauzi. So thank you so much, Mr. Fauzi, for sharing with us your view on the market outlook for the US, China, Hong Kong, as well as Malaysian's market. So, ladies and gentlemen, you just listen to the Chief Investment Officer of RHB Asset Management Sdn Bhd, who is Mr. Mohammad Fauzi. Thank you so much, Mr. Fauzi.
Thank you, everyone. Thank you, Shen.
All right. So if you haven't checked out Bursa Funds platform, you may scan the QR code or click the link that I've given you in the chat box to visit the Bursa Funds platform. So on the Bursa Funds platform, you'll be able to see many unit trust funds that are featured there. So you can explore what are these funds all about and what are the investment objective and how can you gain exposure to the equities or fixed income that this fund have exposed to. So you can check out all these unit trust funds that are available on Bursa Funds platform by scanning the QR code or click the link that is just given you in the chat box. So for our next webinar, it is titled Decoding Structured Warrants Risks and Rewards. It's happening tomorrow night, 2nd of October 2024, 8:30 to 10 p.m. I've also given you the link in the chat box. So if you want to learn about structured warrants, you may click the link that's just given you. All right. So we've invited an analyst from Maybank to talk about this topic. So with that, I want to thank all of you for staying until the end of this session. Hope to see you guys in our next webinar. So remember to check out Bursa Fund platform. Bye-bye, everybody.
Bye-bye. Thank you.
Thanks, Mr. Fauzi.
Thank you, Jen.